You're watching Old and Broke. Meet Jennifer, night shift nurse in Ohio. She checks her phone by the sink. GameStop's near 483. She smiles. By the time her coffee cools, it's a gut punch lower. That whiplash didn't start in her kitchen. It started before sunrise, 5:11 a.m. The clearinghouse that settles trades, NSCC, slaps Robinhood with a collateral call for $3 billion. Robinhood can't eat that number, so they negotiate it down with a catch. By the market open, you can sell GameStop, but you cannot buy it. Wait, can they really just delete the buy button? They don't call it deletion, they call it risk management. When the plumbing demands billions you don't have, you turn off the tap where the pressure's coming from. Retail buys. That day, trading halts stack like dominoes. GameStop spikes to roughly 483, knifes toward 112, and closes near 193. That isn't price discovery. That's collateral math driving the wheel. Name names. The clearinghouse pulled the margin trigger. Robinhood pulled the buy button. Short funds stood under a falling piano and swore gravity was just a theory. It wasn't a crash, it was a kill switch. Free markets are free, right up until freedom gets expensive for the house. Here's your rebellion tool. Assume the platform is a risk. Keep more than one broker. Know if you're in cash or margin. Pre-plan exits before the chaos. Because when the pipes scream, policy beats passion every time. Jennifer thought she bought a seat to a show. What no one told her is they'd already sold her seat to other people, again and again. By late January 2021, reported short interest in GameStop was bigger than the tradable float. The SEC later pegged the peak around 122%. Other trackers had it in the 120 to 140 range. That's not a busy night. That's overbooked reality. How can shorts be more than 100%? Isn't that illegal? Not automatically. Under Regulation SHO, if a broker locates and borrows a share, you can short it. When that borrowed share is sold to a new buyer, the new buyer's broker can lend it out again and again. Each loop creates another short and another owner for the same share. The fancy word is rehypothecation. The plain English is double booking. Naked shorts, shorting without a borrow, are illegal. But this chain, it can happen inside the rules. Now light the match. Borrow utilization is near max. The lendable supply tapped out. Borrow fees spike. Staying short bleeds cash by the hour. The effective float gets thinner. Stubborn holders won't sell. Call options explode. Dealers are forced to buy stock to hedge. That's your gamma fuel. Days to cover stretches. Too many shorts, not enough exits. That isn't price discovery. That's a pressure cooker with the thermostat broken. And yes, fails to deliver spiked in January. That's a stress signal, not proof by itself of naked shorting. In a stampede, even the paperwork trips. Name the villains. Prime brokers renting the same share for a fee and calling it liquidity. Funds like Melvin piling on a crowded short. Loud bears swearing it's a $20 stock. Fast until the fire alarm rings. They didn't just short the stock, they shorted ownership. Selling the same seat 5 times isn't financial innovation. It's Airbnb for a folding chair. Here's your rebellion tool. Learn to spot an overbooked theater. Short interest north of 30 or 40%. Utilization high and borrow fees rising. A sticky float. Insiders and retail refusing to sell. Out of the money calls surging. Implied volatility screaming. Days to cover climbing. While the media mocks instead of analyzes. When those lights dim and the doors slam, the only question is simple. Are you sitting in the chair or holding a ticket to someone else's seat? Wall Street had models. He had a highlighter. Keith Gill, licensed securities pro, CFA charter holder, sat in a basement and read what everyone else skimmed. Cash on the balance sheet, debt shrinking, a new force at the door. Ryan Cohen pushing a real e-commerce pivot from inside the boardroom. And then the fuse, reported short interest hovering around 122% of the tradable float. More claims than shares. He posted the work. Not hype, homework. On Reddit as deep, well, you know, and on YouTube as Roaring Kitty, an initial stake around 53 grand turned into screenshots that made jaws drop. But the point wasn't the number, it was the thesis. Turnaround plus overbooked short interest equals potential explosion. Come on, one guy in a headband moved a multi-billion-dollar market? He lit the match. The room was already soaked in gasoline. Hundreds of thousands picked up the thesis, repeated it, and pressed the same pressure points at the same time. Here's the chain you weren't supposed to notice. Retail piles into out-of-the-money calls, cheap lottery tickets with teeth. Dealers who sold those calls hedge by buying shares. That buying pushes price higher, which forces more hedging, which squeezes shorts already paying rising borrow fees to stand still. Feedback loop. Heat becomes flame, flame becomes halt. While that played out, the usual chorus sang the usual song. TV analysts sneered dumb money. Short bias funds waved off Cohen's plan like it was a pamphlet. Prime brokers rented the same shares again and again, legal if you borrow and locate, then called it liquidity when the math turned into a bonfire. Keith sat in front of a $20 webcam and kept saying the line that mattered. I like the stock. He disclosed. He denied giving advice. He did the thing grown-ups forget how to do. He read. Want the rebellion tool? Build a thesis the way he did, minus the cat memes. Filings, not vibes. 10K, 10Q, 8K. Find a catalyst with real teeth. Leadership that can execute. Strategy that actually changes cash flows. Map the structure. Short interest, borrow costs, days to cover, and who refuses to sell. Watch options flow. When out-of-the-money calls surge, dealers become buyers. And define your asymmetry before you start. How much you can lose and what right even looks like. Name the real joke. 50 terminals missed it. One whiteboard and a headband found it in the footnotes. The headband didn't beat Wall Street. The homework, copied a million times, did. What started as one guy's homework turned into a movement. Jennifer the nurse, Marcus the broke college kid, David the teacher who budgets by flashlight at the kitchen table. People who'd never owned a stock started speaking the same language. Apes, rockets, diamond hands, like a secret code you could read in plain sight. They weren't whispering in back rooms. They were posting screenshots where anyone could see them. Some through stimulus checks, some sold a PlayStation, some just bought a single share so they could say, I was there. The mission wasn't greed, it was grief with a plan. Make the people who called you dumb money feel something for once. Wait, isn't that just market manipulation? No, sharing opinions and buying in public isn't a crime. Manipulation is lying, spoofing fake orders, wash trades, rigging the tape. Regulators dug for a bot army and found a crowd. Messy, loud, human, and legal. Here's the mechanics in plain English. Step 1, the crowd buys shares. Step 2, they buy cheap call options, bets the stock will hit prices it's never seen. Step 3, the dealers who sold those options hedge their risk by buying the stock. Step 4, that dealer buying pushes price up, which forces more hedging, which squeezes shorts already paying rising borrow fees to stand still. It's a feedback loop from hell. Every rocket emoji turns into actual rocket fuel. Meanwhile, the chorus on TV laughed. Reddit degenerates. Short-biased research shops labeled it a $20 stock and called it a day. Prime brokers kept renting out the same shares for a fee and called it liquidity. And the wholesalers who buy your app's order flow? They kept ringing the register. Payment for order flow is how free gets paid. Front-running is illegal, and nobody proved that here. But selling your orders to the house is perfectly allowed. Okay, but how do I not get wrecked the next time the crowd lights a fuse? Do the grown-up version. Do your homework, filings, not vibes. Share your thesis publicly. Sunlight keeps you honest. Only risk money you can bury without a eulogy. Learn the structure, short interest, borrow costs, days to cover, who refuses to sell. Watch the options tape. Out-of-the-money calls can force dealers to become buyers. And write your exit before you enter. Profit targets, pain limits, no heroes. They said memes were jokes. The joke was on them. The memes were messaging, the screenshots were morale, and the crowd was the multiplier. Memes weren't jokes, they were ammunition. Watching cable news explain diamond hands was like watching your parents try to floss. Painful, adorable, and 10 years late. And somewhere between 1,000 buy taps and one grayed out button, the smartest guys in the room realized the room wasn't theirs anymore. In 3 weeks, Melvin Capital bled roughly 53%, about $6.8 billion. On January 25th, Citadel in .72 wired $2.75 billion just to keep the lights on. That wasn't bad luck. That was bad math meeting an angry crowd. How does a so-called meme stock kneecap a multi-billion-dollar hedge fund? Not memes, mechanics. You short a name into the floor on a thin effective float. Retail piles in and starts buying out of the money calls. Dealers who sold those calls hedge by buying the stock. Price rises, shorts pay rising borrow fees to stand still. Days to cover stretches like taffy. The more they fight it, the tighter the vice gets. That's a squeeze. According to Bloomberg and Reuters at the time, the lifeline was real. Two giants stepping in to stabilize a fund that had wandered onto a live grenade. And by January 26, 27, Melvin closed its GameStop short, the damage already welded to the balance sheet. The aftershocks didn't stop. By 2022, the fund shut down. Cause of death, exposure, and ego. Isn't that manipulation? No. SEC staff later said the rocket fuel was retail flow, options hedging, and heavy short positioning. Not bot swarms, not a secret cabal. Translation, the structure did exactly what the structure does under pressure. Name the gears. Short-biased funds leaning on leverage. Prime brokers renting the same shares again and again for a fee and calling it liquidity. Wholesalers monetizing your free trades through payment for order flow while the tape caught fire. Everyone got paid until margin called the bill due. Here's how you spot a forced buyer before the sirens. Short interest already extreme. Anything north of 20 or 30% is danger. More is dynamite. Borrow fees rising, utilization near max. Effective float shrinking because true believers won't sell. Out of the money call volume surging, which turns dealers into automatic buyers. Days to cover climbing. Too many shorts, too few exits. And if fails to deliver spike, treat it as stress in the pipes, not automatic proof of naked shorts. Know your signals, not your slogans. It wasn't a glitch, it was a squeeze. Wall Street called it dumb money, right up until the dumb money turned their models into kindling. And somewhere between a $2.75 billion lifeline and a closed-out short, every risk committee in Manhattan learned the same lesson. Math doesn't care who's wearing the suit. Robinhood promised investing for everyone. Then the morning the crowd showed up, everyone got an asterisk. You could sell GameStop, you just couldn't buy it. Can they really do that? When your clearinghouse slaps you with a $3 billion deposit call before breakfast? Yes. At 5:11 a.m., the NSCC's risk formula spiked on volatility and concentration. Robinhood didn't go broke, it went capital constrained. So they negotiated the bill down, roughly to $1.4 billion by capping risk. Translation, flip the hot names to sell only and stop exposure from growing. They called it risk management. The tape called it a one-way exit. Here's the mechanical truth. Volatility explodes, required collateral surges. A broker without enough headroom kills the buy button to stop the bleeding. The retail bid vanishes, sell orders still route, and price collapses intraday. Not every broker slammed the same door. Some jacked up margins and position limits instead. But Robinhood's retail flow was massive. When they gray out buy, the whole market feels the bruise. Name the gears, NSCC pulled the deposit trigger, Robinhood pulled the buy button. Citadel Securities buys Robinhood's order flow. That's the business model. And the SEC later said it found no evidence Citadel told Robinhood to restrict trading. The optics were ugly. The paperwork says collateral, not collusion. Delete the buy button and you redraw the price. Democratize finance. Right up until democracy votes against the House. How do you keep from getting stranded when BUI disappears? Run two brokers so execution risk can't box you in. Know who actually holds your shares, not just who shows you the app. In chaos, cash beats margin. Margin turns dips into forced sells. Set your exits before the storm. Alerts, limits, rules, so halts and limits don't own you. And watch the plumbing. Status pages, clearing notices, anything that hints the pipes are about to burst. Bottom line, the restriction was imposed to meet clearing collateral. The crash that followed came from asymmetrical order flow. No backroom switch needed, just math, leverage, and a gray button. They called it oversight. It looked like dinner theater. February 18th, 2021, the House Financial Services hearing. Robinhood's Vlad Tenev in one box, Citadel's Ken Griffin in another, Melvin's Gabe Plotkin, and Keith Gill, Roaring Kitty front and center. 5 hours of performance. I like the stock, Gill says, deadpan. We had to meet collateral requirements, Tenev repeats. Citadel did not instruct Robinhood to restrict trading, Griffin swears under oath. A member of Congress actually asks, "Are you a cat?" Gill, "I am not a cat." So, what actually changed? For you, not the thing that mattered. Payment for order flow stayed legal. Sell-only toggles stayed a risk tool on every broker's shelf. The SEC's October 2021 staff report said there was no evidence Citadel told Robinhood to halt buys. It pointed to clearinghouse collateral math and volatility. Later, the market moved to T+1 settlement. Good plumbing, faster pipes, but there's still no rule that guarantees the buy button stays green when collateral explodes. Oversight without teeth is applause between acts. Who played which part? Congress performed outrage for the cameras. Platforms defended their models. Clearinghouses pointed to formulas. Market makers preached orderly markets. And the lobbyists? They wrote the intermission. They asked if he was a cat, you say. Why not ask who owns the leash? Exactly. Here's your rebellion tool. How to read DC theater without getting played. Track what's adopted, not what's promised. Final rules beat headlines. Assume sell-only remains on the menu under stress. Plan exits in advance. Use multiple brokers so one gatekeeper can't box you in. Know your account. Cash versus margin changes how and when you get forced. And watch the plumbing. When collateral, volatility, and risk models spike, someone's about to dim the lights. Bottom line, the record says collateral and volatility drove the decisions. No agency proved a backroom directive, which means next time the script still works. The curtain falls, everyone thanks their donors, and you get the bill. Now the house lights are up, the room is empty, and the mics click off. The theater ended. The tuition didn't. Next, what retail paid and the lessons they kept. Jennifer lost $8,000. Marcus maxed credit he couldn't service. David sold too late. Some walked away rich, many didn't. As the frenzy cooled, attention and volume fell from the January peak, but the anger stuck like scar tissue. The SEC's staff report later dissected what actually happened. Heavy retail activity, especially out-of-the-money call buying. Dealers scrambling to hedge, extreme short positioning, and risk-based clearing deposits driving broker restrictions. Not evidence of a secret directive from a market maker. Fails to deliver spiked briefly amid the stress. This is what tuition looked like. Trust. A crowd that learned free platforms have risk breaks and that brokers can restrict buys to manage collateral and concentration risk in volatile names. Leverage. Margin helps on the way up and hurts on the way down. Under stress, forced selling and block buys can redraw the tape. Structure, the pipes matter. Clearing math, inventory, short interest, options hedging, and who refuses to sell. Fallout, what actually changed? A major short player exited. Melvin Capital told investors in May 2022 it would wind down after losses tied in part to GameStop. Plumbing tweaks, NSCC, DTCC, advanced risk controls, including an intraday volatility charge framework in 2023 to size collateral to fast markets. Settlement speed. U.S. markets moved to T+1 settlement in May 2024. Faster pipes, but not instant. Market structure constants. Sell only remains a permitted broker risk tool under stress, and payment for order flow remains legal in the U.S. regulated under best execution rules. So, what did they actually fix? Some plumbing and margin math? Yes. The core incentives and toggles, mostly still there. The lesson the crowd kept? Understand the machine before you fight it. Rebellion tool. What tuition really buys? If you paid in dollars, make sure you got truth back. Multiple brokers, cash greater than margin in chaos, pre-written exits, and a habit of reading filings over feeds. Track structure, not slogans. Short interest, borrow fees and utilization, days to cover, option flow, float stickiness. Assume the breaks exist. Plan as if buy can go gray again. Tuition is what you pay. Wisdom is what you keep. They said get educated. They didn't mention the final exam came with a ticker symbol. GameStop wasn't a one-off. It was a playbook the crowd copied. By February 2021, the pattern had jumped tickers. AMC, another heavily shorted bricks and mortar leftover, ripped from the low single digits to north of 70 by June. BlackBerry, Nokia, Bed Bath & Beyond, brands written off as relics, got yanked out of the bargain bin by the same combination. High short interest, sticky retail holders, social momentum, and shorts hunting exits. Then the impulse left stocks altogether. Dogecoin, a joke coin with a Shiba mascot, ran from fractions of a cent to roughly 74 cents by May. A tweet could move markets. A late-night comedy skit could vaporize or mint billions. The punchline wasn't about one company anymore. It was about the wiring of the whole machine. Silver got a weekend of Reddit attention and then shrugged it off. The pool was too deep. Lumber futures soared for real-world reasons. Supply chain, housing, and still picked up meme heat because anything moving got a crowd. What actually powered the spread? Retail options as rocket fuel. Call buying and meme names exploded versus 2019, and dealers hedged by buying shares. On-demand gamma. Zero commissions, near zero friction. If clicking was free, clicking happened more. Fractionals. $5 could buy a sliver of anything. Social proof at scale. Upvotes turned due diligence into distribution. Memes made the message travel. Wall Street adapted, fast. They stopped fighting the tide and started bottling it. Packaged exposure. If retail chased it, someone ETF'd it. Social sentiment in meme theme wrappers you could buy in a ticker. Same-day options. Zero DTE contracts went from curiosity to a habit, swelling to roughly 40 to 50% of SPX option volume by late 2023. Maximum leverage, minimal patience. Crypto on-ramps. The retail apps pushed spot crypto. The incumbents offered futures, thematic funds, and retirement access. If you wanted the casino, there was a door. Casualties on the victory lap. AMC diluted. Management raised cash into the rally. The stock that tagged the 70s in June 2021 traded for pennies on the dollar by late 2023. NFTs round-tripped. Turnover peaked in the tens of billions and then fell more than 90% by 2023. Crypto winter. Doge bled back under 10 cents. Bitcoin slid from 69,000 to sub 16,000 in November 2022. What the tape remembers, retail's footprint roughly doubled from pre-pandemic levels into 2022. Options skewed younger and shorter dated. More leverage, less time. Volatility stayed elevated versus 2019, even as it cooled from 2020 peaks. So what did the contagion prove? That retail doesn't just buy and hold, it coordinates, leverages, and narrates. Fundamentals didn't vanish. They got drowned out whenever flow, positioning, and crowd psychology lined up. Wall Street learned the lesson too. Don't scold the behavior, monetize it. More wrappers, more experies, more ways to press the button. Rebellion tool, reading the next outbreak. Watch the options tape. Unusual call volume in crowded shorts is your early siren. Track sentiment velocity, not just volume. When DDS and memes hit front pages, the trade is already recruiting. Follow the friction. Any new feature that makes speculation easier, cheaper, faster, smaller, is a potential spark. Remember the recipe. High short interest plus sticky holders plus coordinated narrative equals squeeze candidate. Don't chase blindly, map the exits. The meme became the message. The message became the market. They called it dumb money. Dumb money learned to synchronize faster than smart money learned to adapt. GameStop wasn't just a stock story. It was a stress test. It showed where the pipe's grown, who gets rationed first, and how fast access can change when risk models blink red. Here are the receipts. In June 2021, FINRA hit Robinhood with a record $70 million penalty, about $57 million in fines and $12.6 million in restitution, for platform outages, options approval failures, and misleading communications. Not the buy button day itself, but the same era of strain that revealed how fragile free could be. At 5:11 a.m. on January 28, 2021, the clearinghouse that nets trades, NSCC, called Robinhood for roughly $3 billion in deposit. After the firm imposed buy restrictions, that requirement was negotiated down to about $1.4 billion. Later, the SEC said the driver was volatility in clearing math, not a market maker's directive. Free trading, meanwhile, ran on payment for order flow, hundreds of millions in broker revenue in 2020. Free wasn't free. 3 lessons made it through the memes. Lesson 1, liquidity is conditional. Your buy button works until a risk model says it doesn't. In stress, brokers ration exposure, even if the market looks open. Lesson 2, complexity is fragility. Multi-day settlement, lending chains, and margin formulas can reprice your access faster than you can react. Lesson 3, asymmetry persists. Retail sees part of the tape. Clearing and prime desks see the rest. The field isn't level, it's built with tilt. So what actually changed? The US moved to T+1 settlement in May 2024. Faster pipes, but not T+ instant. NSCC added intraday volatility charges in 2023 to call for more collateral when risk spikes. Exchanges expanded same-day expiry options. 0 DTE. Usage surged and remains controversial for its leverage and gamma sensitivity. Payment for order flow stayed legal. Sell only remains on every broker's risk console. What should you do about it? Diversify your infrastructure. Run 2 brokers so one gatekeeper can't box you in. In chaos, cash beats margin. Margin turns dips into forced sells. Know who actually holds your shares. Read the fine print. How your broker gets paid. What triggers restrictions. When and how forced liquidations can happen. Who the clearing agent is. Plan for stress. Write exits before emotions. Keep dry powder off platform. Screenshot and timestamp anything unusual. Call it tuition if you want. Dollars lost, buy lessons kept. If you walked away with clearer rules, sturdier setups, and a map of where the machine breaks, that wasn't just pain. That was the receipt. The house always wins until you learn how the house is built. The most expensive information is the part they don't advertise. You're watching Old and Broke. We don't predict the future, we just pay attention. Hit like, hit subscribe, stay sharp.